Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money.
So the power law is the most quoted idea in angel investing, and it's also the one that everyone gets wrong. Everyone thinks it means you have to swing for a multi-billion-dollar company when you invest, and so they sit on the sidelines and never start.
We're kicking off episode 21 today of Angels Decoded, talking about the power law. The power law is something that exists as a term, and it comes from VC historically, right?
No, I think it comes from nature. Like, it's how nature works. It's the, one big winner or one big event, one big thing. It's the outlier can dwarf everything else. But yes, VC has so overused it, they've sort of made it their own.
In context of investment world, power law ultimately means that it's the return on their fund where a small percentage of their bets are the ones that are going to drive the majority of the return for their LPs.
Yes, and they've conflated it though. They've twisted that idea, right? It went from like, sure, one big winner can outstrip a whole bunch of other stuff, but now it's become only the one big winner counts and nothing else matters. And they have equated, the power law is a proportionality thing, and they've equated power law with an absolute number. That number used to be $1 billion. Now it's $10 billion. Tomorrow it'll be $1 trillion. Yeah, they've taken it a little bit too far.
Problem that I see too is how far it's gone is that it almost now lives within the thesis, where as an assessment tool, if your valuation is 200 million and you might not get past that, they won't invest in you, even though you could drive a huge multiplier and a return, because for them, it doesn't repay back the total fund amount enough, so they decline you, which is crazy that it based on the fund size and what they need to return, that's how they make a decision rather than if they make a return on this company or not. So they're losing out on all of these companies that could be really successful for them.
Well, it's so interesting because what the word you said there was so important. It's the multiplier. And that's how we as everyday angels should think. It's what's that multiple return I am getting? In VC, they want to just deploy so much capital that like that multiplier actually now ties itself to a large amount of capital they want to deploy, and then it multiplies out to $10 billion. So they just start out with everything must be $10 billion. Or we don't care. So if it's, a business doing, that could be a $100 million business or even a $500 million business, it stops mattering to them. So they might as well shut it down. Multiplier is a key word there.
And they're building on that again. The other one to understand as well is that if their fund size keeps getting bigger and their multiplier needs to get bigger, then you also start to narrow down the number of people that can acquire you. So what they're relying on is that company has an exit, right? So if the valuations keep going up, the pool of acquirers gets smaller and smaller as well, because they need to have a significant amount of capital to actually acquire that. So again, you're almost a victim of your own success if you apply the power law to that point. Whereas if you had the ability to maybe have 10% of your fund return, and that's where I want to go back to you. So from an angel investment thesis perspective, we know the data on how many bets you need to make. The philosophy and the thinking and the science that goes behind that is very different. And that's the tension we're unpacking today, is the contrast of angel investing versus VC investing.
Because as I say all the time, angels are not small VCs. Our math is fundamentally different. And we play in the space. I mean, it's so interesting. We get all this like credence to like the power law and those big unicorns. But on a diversified portfolio, you do better than public market returns without ever getting one of those big power law unicorn returners.
And you don't have the relationship of an LP and being beholden to people that are investing in your fund. You're an independent investor who is putting your own personal money in there. And Cheryl, let's play it back for those listening and watching at home. We talk about this number a lot. What's this number of angel bets you need to put down to drive a return or have a higher chance of getting a return?
The magic number is 30. 30 angel bets starts to perform like a predictable high-performing asset class, not a bunch of one-off lottery tickets.
And that data comes from your friend at AngelList.
It does, Abe Othman. Dream boy.
Abe's ears must burn quite often when we record these episodes. He comes up a lot. He is the man.
He could get a restraining order out of me if he wanted to. I think it's a little creepy, so I should probably tone it down. But I'm a girl that loves math and data, so
It's
And
important because if you're not looking at the data and looking at a broad range of information sources, you're caught up in the noise. And that is a double negative for you personally and for startups that are going to miss out on your money because you take this conservative power law approach that is not appropriate for what you're doing.
Yep. And if you look at startups, the data I love is that like about 90% of the exits in the startup space happen under $100 million. And there's a few things that go on there. Like, first of all, it's easy to sell a company for under $100 million compared to selling one for tens of billions of dollars. It's a lot less riskier. Things move a lot faster. I think the median exit actually was around $44 million. So that $50 million sweet spot. If you raise capital smart as a founder, you are going to make life-changing wealth at a $50 or $100 million exit. If you get in early as an angel, the word you said before, multiple, that is a monster return. You don't need to touch those $10 billion winners to have an amazing startup portfolio that performs much better than public market with a whole bunch of, what a VC would call base hits.
And the base hits is what makes you return as an angel investor. And that runners on base, I'm going to go to Moneyball analogy here of baseball. It's just getting people on base. That's what you're playing. You're playing a smarter long-term strategy to be able to drive returns. And to your point, $100 million exit, there's so many more people that can do that. So you have a much higher chance of an exit. And typically, if you're at that level, it's a shorter turnaround time as well, is what happens. So if you're getting into the billions, then it takes longer to get to that point. So you're not liquid. So if you can put 30 bets down and you have $100 million exits across those 30 bets, not only will you drive a much higher return, it will happen in a shorter timeline as well.
Absolutely. And this is my little latest geek fixation has been regional startup ecosystems. This is exactly the kind of money in motion that local markets have when it comes to private companies and startups and angel investing, right? They can, because they don't have money thrown at them all the time, it's better for them to raise from angels. And they'll figure out their business faster. They'll get more sort of non-capital leverage from those angels faster, and they can figure out the shape of their business. And if they're sitting on a business that should be a $10 billion business, they'll figure it out, and that capital that they need to get there will come. But if they're a $50 million business or a $100 million business, they'll retain the optionality to build that way and to return that way. And those returns will come faster. They'll come at lower risk. I mean, how many companies, if you're in an insider game, you have seen so many companies that could have exited for 100 million, 200 million, even 500 million. And the VC said, nope, that's not enough. Go, gun for bigger. And you know what those early stage investors or those founders even have gotten out of those investments sometimes? Very, very little. There's so many stories of founders that would have made more money, which means their angels would have made more money if they had exited earlier for 50 or $100 million than they got hanging on. Like, crazy thought.
It's such a false attribution in the sense of bigger revenue, bigger multiplier, bigger exit is not necessarily the case, because I'm going to apply power law as a term to another dynamic too. The further you go, the more fundraising you have from traditional VC means that you start to hand power over to somebody else as well. And then all of a sudden, from an exit perspective, as a founder, you're actually not making the final decision anymore. You've got other stakeholders that have a greater share in your company that can tip the scales against you. So as an early angel, you don't have any say at that point. So you start to also lose the chance of success of an exit, because they're pushing for their own, as in the VCs are pushing for their own personal multiplier to hit their metrics, not what's best for all the shareholders.
Absolutely. That is absolutely what happens. So it's funny because, as angels, we hear from VC, we're told, oh gosh, the only companies that matter are the ones that get to $10 billion. And then we see really big everyday problems that we want solved. We see founders solving them. Those founders may be local to us, and we get scared. We're like, can that be a $10 billion company? I don't know what to do, because no one talks about the actual exit dynamics that happen in angel, the actual portfolio building that you can do if you're an angel. And no one has ever mapped out the math and told us, no, actually, you can significantly outperform public markets with a whole bunch of base hits. Like, that's a big nugget And if some of those base hits are in your local ecosystem, you are going to get like secondary and tertiary benefits just because your whole community benefits, more jobs, more wealth in the community, all sorts of great things.
And I want to pick up that theme a little bit. In episode 19 and 20, in episode 19, you're in Alabama, and in episode 20, we unpacked that a little bit further again, because there's a huge opportunity in these businesses because they're not getting access to traditional VC capital. There's a lot of businesses that can be successful and hit those $100 million exits. So the local community and local angel investors have even a bigger opportunity because they're getting access to deals that no one else is even looking at. And that is, for me, the part that I love with these conversations is that the 97% of accredited investors aren't investing in angels. They're the ones we want to find, and they're the ones that will benefit from the opportunity of VCs being myopic based off geography and relationships because it makes their job easier.
Absolutely. And it further compresses the price you buy in at. And if it's all about multiples, getting in a company early at a $5 million post-money valuation is way more interesting than getting in at a 20 million or a 50 million. You sell for 50 or 100 million and you're in at 5, and all of a sudden there's money flowing everywhere. Everyone wins. Such an opportunity.
Absolutely. And if you look at traditional multipliers, depending on the category of that business, if they have a high retention rate and they have longevity of clients, then the ability to get a higher multiplier, you can get 10x multipliers. So they only need to be doing $10 million annual revenue a year to get to that 100 million valuation, doing simple math around it. So again, 10 million in annual revenue is not a lot for some of these categories of businesses. So that timeline, the opportunity, the exclusive nature of having access, that multiplier is big. I would put down $1,000 deals in 30 investments across those types of businesses any day of the week. For me, it screams a bigger opportunity.
Absolutely. It's funny though, because because we get the stories all the time from big VCs, we're told to believe that a company's ability to raise money is a sign of success. And if you look at the actual facts, there's very little correlation between the amount of money a company raises and the success they have. So that's the other myth that stands in the way. Whereas what we really should be saying is exactly what you said. I'm going to make $31,000 bets all day.
I can just put a little bit of a reframe on what you just said, that 95% of VC invested companies don't exit. So if you talk about success rate, as someone trying to tell me, gaslight me, in that if you can fundraise, then you can be successful. It's like, no, the data actually tells you the complete opposite. And the power law is the thing that supports that. So they're being completely contradictory in the narrative that they're spinning for their own personal benefit.
100%. So if us as individual angels just start looking at common sense and understand the real data, a portfolio of companies that exit at 50, 100, 200 million, we are winning all day long. And those are really, I don't want to say easy, but easy exits to make happen. They happen all the time.
Cheryl, I love that you brought the spice out of me. It's normally not my role to get a little bit spicy
in
these
really
episodes.
Fun today. Yeah, you were the one. You're going at it.
I love it because I'm a skeptic, because I see it from the other side. I spend most of my week talking to founders, and I see and hear the challenges that they go through. And a lot of it is so unnecessary with the way the influence comes from VCs, and not to paint a picture of all VCs being bad, but there are territorial people out there that will exploit situations, and there's ones that are in it for themselves, and they utilize their portfolio as chess pieces, and they're happy to knock a chess piece over to win the game long term, right? And that means that a founder and their startup are the victim of that.
My gosh, we're going to do a total weird role reversal here, because I'm going to come to the defense of the VC on this one. You just sort of threw him under the bus. I'm like, no, VCs have a job to do. They have sold a product to their investors. They're just delivering on what their job is. I think we just live in this la-la world of someone should be nice to me and good to me. A VC is doing a job. We as founders need to understand what that job is and how to best capitalize our companies for our correct long-term outcome. And frankly, if the founder is optimizing for their long-term outcome, they're sort of optimizing for their angels' long-term outcome. So I'm not going to throw the VCs under the bus. They are just doing a very good job at the job they're being paid to do. The rest of us need to understand that job and understand how to work with it. and not think we are also doing that same job as angels. We have a different job to do.
That's fair. And there was no thrown under the bus. There was asking some serious questions.
I love that. Oh, it's thrown under the bus to me. Let me defend the VCs. That's a new role for me.
What?
I am the Lorax. I speak for VC.
We have changed roles today, my
Oh
friend.
my God, it's all crazy here now.
It is. So any parting advice for angels on the power law, and what should they walk away with today?
The power law is true. The biggest, the biggest of something is going to have the biggest effect. But the power law doesn't have to have a dollar amount tied to it. Focus on the multiples. A whole bunch of base hits in your portfolio, which is you're very likely to get with a diversified portfolio, makes this a winning asset allocation strategy. So don't sit on the sidelines thinking you're not going to get the next Uber.
You've got to put the bets down at scale to drive that. What a great way to leave. Cheryl Kellond, episode 21 of Angels Decoded. I'm Andy Walsh from Startups Decoded. What a great time of the week to sit down with you.
What a fun episode. I'll see you next week. Bye now.
Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.